Non-current long-term liabilities, financial reporting and analysis. Example 1, bond issued at face value. D-Bond Corp issued 1 million worth of 5-year bond dated 1st January 2018 when the market interest rate on bonds of comparable risk and return is 5% per annum. The bond pays 5% interest annually, so the coupon rate is also 5%. What are the sales proceeds of the bond when issued, and how is the issuance reflected in the financial statements? Now, we have issued a bond and N equals to 5 because it's a 5-year bond. Interest rate is 5%. PMT or coupon is also 5% multiplied by 1 million. This is 50,000. Present value is what we need to find out, and future value or the face value is 1 million. Now, because interest rate and coupon rates are both same, so the present value will also be 1 million. Now, calculating the value of the bond at issuance and thus the sale proceeds involve 3 steps: identify key features of the bond and the market interest rate, determining future cash flows, and discounting the cash flows to the present. Now, first we identify the key features of bonds and the market interest rate necessary to determine sales proceeds. Now, these are the different variables that we have calculated, and we need to also keep in mind that the interest rate that we are paying is annual in nature. So the interest rate is 50,000. Second, determine future cash flows. So if we have a 5-year bond, each year we are getting 50,000. So 50,000 needs to be divided by 1.05 and with respect to the time. So for example, in the 3rd year, 50,000 needs to be discounted by 1.05 raised to power 3. So these are the different interest payments. Each interest payment equals to 50,000. This is the market value. So 50,000 divided by 1.05 would be 47,619. This 50,000 divided by 1.05 raised to power 2. This one would be divided by 1.05 raised to power 5. In the end, we are also getting the face value. This needs to be divided by 1.05 raised to power 5 as well. And hence the total present value equals to 1 million, and this is our sales proceed. The sales proceed of the bond when issued are 1 million. There is no discount or premium because these bonds are issued at face value. Whenever we have interest rate and coupon rate equal, then the bond is issued at par. The issuance is reflected on the balance sheet as an increase of cash and an increase in long-term liability bond payables of $1 million. So asset equals to debt plus equity. Your debt goes up, your asset will also go up by the same amount. The issuance is reflected in the statement of cash flows as financing cash inflow. So one is the balance sheet. The balance sheet goes up, long-term liability, bond payable by 1 million, and cash flow from financing also goes up by 1 million. Example 2, bond issued at a discount. So whenever the coupon rate is less than the interest rate, then the bond is issued at a discount. So D-Bond Corp issued 1 million worth of 5-year bond. When the market interest rate on the bond bonds of comparable risk and terms is 6%, the bond pays 5% interest annually. What are the sale proceeds of the bond when issued, and how is the issuance reflected in the financial statement? So N equals to 5, interest rate equals to 5%, PMT, the coupon rate, the interest rate is 6%. So the interest rate is 6%, PMT, the coupon rate remains the same, 5%, 1 million is 50,000. Present value is what we need to find out, and future value equals to 1 million. So if we use our financial calculator and we put the numbers, N equals to 5, 6% is your interest rate, 50,000 is PMT, 1 million is future value, and we compute the present value, we get 957,000. So the present value we get is 957,876. Now if you want to find out the present value through this methodology where each cash flow is discounted, so 50,000 will be discounted by 6%. So 50,000 divided by 1.06 would be 47,170, because the interest rate now is 6%, and we also need to discount the face value. So this would be 1.06 raised to the power by 5. we get 747,258, and the total sale proceed would be 957,876. So our cash flow from financing will again go up by 957,876, and the balance sheet long-term liability, so long-term liability bond payable will also go up by 957,876. And the bond sells at a discount of 42,124. So the par value or the face value was 1 million, but at time zero we are able to get 957,876, and we have a discount of 42,124. Example 3, amortizing a bond discount. So D-Bond Corp issues 1 million face value of 5-year bond dated 1st January 2017 when the market interest rate was 6%. The sale proceed at time zero, we get 957,876. This is what we get. Now, what is the interest payment on the bonds each year? So the interest payment is your coupon payment. So coupon payment is 5% of 1 million, that is 50,000. What amount of interest expense on the bond would be reported in 2017 and 2018? Now, we also need to understand that your interest expense is not your 50,000. This is actually your interest payment. Your interest expense is dependent upon your initial cash inflow. So 957,876 multiplied by 0.06, we get, so 57,473 is your 2017 interest expense. Now in 2018, what will be the interest expense? Now out of 57,473 that we need to pay as our interest expense, we only paid 50,000. So the extra 7,473 would be added to our proceeds because we are unable to pay 7,473. So our liability will going to go up. So the liability increases by 7,473. So 957,876 plus 7,473. So our liability in 2018 would be 965,349, and the interest would be applicable on this amount. So we need to multiply this by 0.06, and we get 57,921. Now in this table we are given that initially the carrying amount was 957,876. So interest rate, so if you multiply this by 0.06, this is our interest expense. We were only able to pay 50,000, so this is your discount. This needs to be amortized, and this needs to be added to 957,876. So your carrying amount would be 965,349. So this is what we got, and the interest expense would be now applicable on 965,349 because our liability has actually gone up because we were unable to pay the total interest expense. So out of 57,921, we only paid 50,000. So again, 7,921 needs to be added to the carrying amount. So the new carrying amount would be 973,270. And as we can see, if the bond is issued at a discount, the bond converges towards the par. So in the end, the carrying amount would be $1 million. Determine the reported value of the bond, that is carrying amount at the 31st December 2017 and 2018, assuming the effective interest rate method is used to amortize the discount. So effective interest rate method is being used. So in 2017 and 2018, we have just established these are our carrying amount. Now what amount of interest expense on the bond would be reported under the straight line method of amortizing the discount? Now what was our discount value? So discount value was 42,124. So in straight line methodology, 42,124 needs to be divided by 5 because this discount is spread over 5 years. So the discount would be amortized by 8,424.8, 8,424.8, and the interest expense under the straight line method would be 50,000 plus 8,424.8. So this would be 58,424.8 because the bond was actually a discount bond. If this was a premium, then the amortized amount would be subtracted. Example 4, amortizing a bond premium. A prem Prem Bond Corp issued $1 million face value of 5-year bond. The market interest rate was 4%. The sale proceeds was $1.044518 million. So N equals to 5, interest rate equals to 4%, PMT 50,000 because the coupon rate is 5%. Present value, future value equals to 1 million. So if we calculate the present value, we are going to get $1.044518 million. What is the interest payment on the bonds each year? So the interest payment is again 50,000, but the interest expense would be 1044518 because this is our liability initially multiplied by 0.04. This amount would equal to 41,781. This should equal to 41,781. Now we need to understand that initially the carrying amount is 1.044518 million. It's a premium bond. Our interest expense is 41,781, but we paid how much? 50,000 we paid. So not only we paid the interest, we also paid some amount of principal. So how much of the amount of principal we paid? So 50,000 minus 41,781 is 8,219. Now the carrying amount would be reduced by 8,219. So 1.044518 million minus 8,217, we will go to get 1.036298 million or 299 million. And the interest expense at the end of 2018 would be carrying amount, that is 1.036299 multiplied by 0.04 because this is our interest rate. So our interest expense would be 41,552, and this can be shown over here as well. So the carrying amount initially is 1.044518 million. This is our interest expense. We paid 50,000. So not only we paid the interest expense, we also paid some amount of premium. This is the amount of premium we paid. This is your amortization of premium. Carrying amount would be from 1.044518 would be reduced by 8,219 to 1.036299 million. So the next year interest expense would be carrying amount multiplied by 0.04, and this is what we get. Now we need to understand, if it is a premium bond, again it will going to converge towards the par. So in the end the carrying amount would be $1 million because each year the premium would be subtracted because we are paying more, that is we are paying 50,000 and our interest expense is less than 50,000. So we actually pay not only the interest rate but also some amount of premium. Determine the reported value of bond at 31st December 2017 and 2018, assuming the effective interest rate method is used to amortize the premium. So in 2017 and 2018, so in 2017 1.036299 is your carrying amount, and in 2018 it is 1027751, and the initial premium was of 44,518. What amount of interest expense on the bond would be reported under straight line method of amortizing the premium? So initially the premium was 44,518. This would be divided by 5, and the premium we were going to get would be 8,903.64. So the interest expense would be 50,000 minus 8,903.64, and according to the straight line method, $41,096.36 would be your interest expense. That is 50,000 minus 8,903.64. So your interest expense would be $41,096.36.